Am I audible?
Yes, sir.
Okay. Just 1 second. Just a second. Are you guys able to see the presentation now? Is anyone confirm? Then we start. Okay. So in this sessions, we understand the we can say the third chapter of the financial reporting. That is, we can say the presentation of the financial statements and revenue recognitions that we are going to understand in this session. That is the AS1 and AS7 that we briefly understand in the last sessions. Actually, in this sessions, I show you the exact documents of the AS1. Okay, so what are the things written in the AS1? What are the different guidelines that is provided by, we can say, the Companies Amendment Act 2015? So that all part I show you in this sessions. Okay, so under we can say the Indian Accounting Standard AS1 and AS7, that is we can say the comprehensive guidelines which given by the AS1 and AS7 to understand, we can say, the principles and requirements. Okay, what are the different practical applications of the Indian Accounting Standard while the preparation of the financial statements, that we are going to understand that part in this session. Okay, so first we understand the foundation of the financial reporting. What is the AS1? What AS1 tells to the companies, to the organizations while the preparation of their financial statements. So the, we can say, the Indian AS1 serves the we can say one of the most important part. We can say it is the cornerstone of how the entities present in the financial statements under the Indian accounting standard. Okay, so this standard ensures the financial informations which included by the companies in their financial statement should be presented in a structured, transparent manner that enables the user makes the informed economic decisions. Okay, so for that purpose, we can say the AS1 is provided by the Companies Amendment Act 2015. So I'll show you the AS1 PDF. Okay. So are you guys able to see the PDF? Please, anyone confirm?
Yes, sir.
Okay, so guys, see, this is the if you see, this is the actual Indian accounting standard AS1 document. If you see, that document is of the 35 pages documents. That means a brief guidelines provided by the Companies Amendment Act 2015 to prepare the financial statement. Okay, now I enlarge so you guys can read. Okay, so this document, this is the Indian accounting standards, that is AS1. So what is the objective here written? So what is the objective of the AS1? If you read it briefly, I read for your convenience. As this standard describe the basis for presentation of general purpose financial statement to ensure the comparability both with the entity's financial statement of the previous periods. That means this AS1, we can say, provide the generalized guidelines for all the four statements. That is the balance sheet, we can say the cash flow statement, income statement, and statement in changes in equity. So for all these, the general guidelines which provided by the AS1, that is the first objective of AS1. It also tell that it is the set out of overall requirement for the presentation of the financial statements, guidelines for their structure and minimum requirement of the country. That means this AS1 tells us the we can say what should be the structure of the financial statements. Okay, so likewise, if I show you in the 35 pages, the detailed guideline is given. So next part we can say what is the scope. That is the to which we can say what is the scope of the financial statement. Mhm. That is means we can say to which financial statements or which financial information that AS1 is applicable. Okay, so that is we can say that is the scope of the AS1. So in scope, here we can say the written that entity shall be apply this standard in, we can say, in the preparation and the presentation of the general purpose financial statements in accordance with the Indian accounting standards. Okay, so all the company, that means all the organizations, all the companies who are at the end of the financial year, they, we can say, they prepare the financial statements. Okay, which is mandated by the, we can say, some of the regulatories like SEBI. We can say the governments also mandated to disclose the financial informations. Okay, so while the preparation, the companies should follow the AS1, the generalized guidelines provided by AS1. Okay, so we can say here in scope, that is, all these things are written, that is the standard uses, the different terminologies are given in this AS1, that is the profit oriented entities, including public sector business entities. Okay, if the entities with not profit activities, that is the non-profit organizations, or the for the profit organizations, so the different guidelines are provided. Okay, so all we can say AS1 is these are the generalized guidelines. Here some of the definitions are given for, we can say, of the different terms. Okay, so here if you see guys, if you see, I show you, I enlarge the documents for your understanding. Here the different definitions are given. Okay, if you see here, the different definition of the change in revaluation surplus, we can say the gains and losses arising from, so all these things are included ES1. We can say the ES1 is the generalized guidelines, that is the combination of all the AS, that is the things which we study in the different areas. For all these the generalized guidelines are provided in the AS1. If you see in next part, what is given, that is the what are the different financial statements, and what is the purpose of the financial statement, why the companies disclose, we can say, or they prepare the financial statements. So here in AS1, the purpose is given by the Companies Amendment Act. If we read the purpose, the financial statements are a structured representation of the financial position and financial performance of an entity. The objectives of the financial statement is to provide the information about the financial position, financial performance. Okay, so balance sheets gives us the financial position, income statement gives us the financial performance also, and the cash flow of an entity, that is useful to a wide range of users in making the economic decisions. Okay, so the financial statements provides the, we can say, guidelines to the stakeholders to take their investment decisions or the economic decisions. Also, if you read further, that financial statements are also show the result of the management, we can say the stewardship of the resources to meet the objectives. The financial statement uh, provide the information about the sum of the things, that is asset, liabilities, equity. Okay, yeah, in balance sheets we calculate the assets and liability. In changes in the equity statements, we can say we think of the equity. In income statement we think of the income and expenses, and the contribution by and the distribution by owners in the capacity as owner. Okay, we see that in the changes in the equity statement. And last one is the cash flow. Okay, so that is given. Here is the list of complete set of financial statement is given. Okay, if you see, if you read, that is the balance sheet at the end of the period. That is the one financial statement. The, we can say, a statement of profit and loss for a period, a statement of changes in equity for a period, a statement of cash flow for a period. Okay, so these are the four important financial statements. Now, next, if you read the E, uh, then that is the notes comprising the significant accounting policies, and the other explanatory information. So the notes for the different financial transaction that should be there in the financial statements. Okay, if we read the EA, that is comparative information in respect of the preceding period as specified in paragraph 30A and 30B. Some of the comparative information from the previous year should be there in the financial statements for the understanding of the readers of the financial statements. Okay, if we read, so all these guidelines must be followed. Okay, while the preparation of the financial statements. Okay, now next, if we read, that is the what is the we can say the uh, general features, that is the presentation of the true and fair view and the compliance with the AS1. That means the whatever the information is published by the company, that should be a true and fair. Okay, here the point 15, if you read the point 15 with me, guys, please read it with me. Then you can understand that what how the guidelines provided by the AS1. Okay, so this is the 35 pages, we can say guidelines, 35 pages PDF. Okay, so not we can say the every accountant can mug up. Okay, uh, so by reading this, we understand. Okay, that means before the preparation of the financial statements, that's each accountant, or we can say the financial expert, they should read all these AS. Okay, so they can include all the guidelines in the financial statements. Okay, the next part here given. So all these are the guidelines, guys. You uh, Mm, I'll share this document with you. Okay, so you can thoroughly read the document, because it is not possible for us to read, we can say, the whole document thoroughly in the sessions. Okay, because we have the time limitations. Okay, so we read only the important guidelines. Okay, so here we read the point 15, that is the financial statement shall present the true and fair view of the financial position and financial performance of the cash flows of entity. Okay, that I already told you that the presentation should be a we can say fair. The presentation of the true and fair view requires the faithful representation of the effects of the transactions. That each entry should be a we can say the realistic one, so that the different stakeholders can we can say have the faith in the financial statements, that the representation of the different parameters in the financial statement should be a faithful representations, because we know that the different stakeholders are depend on the financials, the information included in the financial statement. So what the Indian accounting standard one wants, the information should be the faithful one. We can say here we if we read the some of the important, what the next is the we see that what are the different parameters should be followed while the preparation of the financial statement. I told you the three principles must be followed while the preparation of the financial statement. That is the going concern, accrual basis, and we can say the consistency. So here you clearly see that going concern is we can say mentioned here. That means what is meant by that going concern? Okay, so all detail is written here. We read and we understand what the going concern. We know that the company is continuously doing the business. Okay, what we assume that the company, we can say, we cannot consider work for only the 7 months, 6 months. It is the business is the continuous process. That is the going process. So we read and understand what is the written, what the guidelines tells us. When we can say the preparing the financial statement, management shall make the assignments of the entity's ability to continue the going concern, and entity shall prepare the financial statement on a going concern. That means business should be we consider always should be a continuous process. Okay, uh, going concern basis unless the management neither intend to liquidate the entity or to cease the trading. That means when management thinks to sell the organizations, to sell the company, okay, to wind up the company, okay, till that date, we consider that business is a continuous process. Okay, so that we can say must reflect in the financial statement. Okay, we can say liquidate entity, that means selling of the entity or to cease the trading, to cease the business, or has no realistic alternative but to do so when management is aware in making its assignments of the material uncertainties related to the events or conditions that may cause a significant doubts upon the entity's ability to continue as a going concern. Okay, so the entity shall disclose those uncertainty. Okay, if you know, if we are producing, we can say if we are producing the clothes, okay, but the cotton's production from last 5 years is we can say very low in Maharashtra or in India. So our cotton, we can say we don't have the raw material to produce the clothes. So that is we can say a major concern that the business may we can say stocks. The business may stop in a while, okay, in some period because of the uh, unavailability of the raw material. So that should be mentioned in your financial statements if if this such a major concern is going on any organizations. Okay, so that may affect the going concern of the organization. Okay, so that financial information should be there in the financial statements, so that whenever the stakeholders, whenever we can say the investors, he reads the financial statements, then he must aware of all these things. Okay, so the entity shall disclose all these uncertainties when an entity does not prepare the financial statements on a going concern basis. It shall disclose that fact. Okay, whenever the company is not, we can say, uh, not showing the continuity in the financial statement, then they are liable to give the reasons for that. Okay, that is the AS, the accounting standard ones. We can say instruct the companies that why you not add the going concern, that it shall be disclose the fact. Okay, what is the fact? We can say the unavailability of the funds, or the reason may be the unavailability of the raw material. Okay, so whatever it may be, so that fact should be disclosed. Okay, so okay, so next we can say the accrual basis accounting. Okay, so that principle should be added in the financial statement, that an entity shall prepare its financial statement, expect for cash flows information using the accrual basis accounting. That means whenever a revenue recognized, whenever the expenses recognized, okay, at that point only we put that transactions into the on that date only we can say have an entry of the transaction. That is when the accrual basis of the accounting is used, the entity recognize items such as assets, okay, liabilities, equity, income, expenses. That is the elements of the different financial statements. When they satisfy the definition of the recognition, means the actual we can say receive or the actual uh, yeah, that is the giving. So that actual recognition criteria for those elements in the framework. Okay, so that should be you can say consider while the preparation of the uh, financial statements. Okay, or we can say now the here somewhere the consistency should be there. Okay, where is the consistency? Somewhere. Here the consistency of presentation. That means that the the preparations or the format the company is using for the preparation of the financial statement should be that format should be a consistent. Okay, because if for the years of data the company wants to compare, okay, for its own data, then their consistency of the financial statement should be there. Okay, that it is not the case. Maybe if in between the 2 or 3 years the company is not prepared the financial statement. If the company miss the preparation of the financial statements for any of the 2 or 3 years, then the company is incapable to compare its financial position for different years. Okay, so the consistency, that means in each and every year the company should prepare the financial statements. They should follow the, we can say, the identical format. Okay, so what is written in the consistency of the presentation? If we read, then entity shall retain the presentation and classification of the items in the financial statement from one period to the next period. It is an apparent following the significant change in the natures of entity operations or the review of its financial statement that another presentation or classification would more appropriate, having the regards to the criteria for the selection and application of the accounting policies in Indian AS, and Indian AS requires the change in the presentations. Okay, so accordingly, whenever the AS provides the guidelines, so the companies should change their presentations. So this is some guidelines, that is the structure and content. Okay. Just a second. Is my voice is clear to everyone? There is some technical glitch. Okay. Just a second, guys. Okay. Okay, so these are guidelines we are reading. That is the for the AS1. Okay, so here are some identification of the financial statements. Some guidelines are given. An entity shall clearly identify the financial statement and distinguish them from the other information in the same public document. Okay, so the clearly we can say the identified the financial statement should be the we can say the clearly identified. Okay, so here are some guidelines. If you see for the balance sheet, guys, see for balance sheet here written is for balance sheet the some guidelines are given. So we read that is information to be presented in the balance sheet. Balance sheet shall include the line items that present in the following amounts. Okay, okay, so that should be there in the balance sheets. Okay, so what are the things? What are the different parameters should be there in the balance sheet? So that is given in the AS1. So that is the property, plant, and the equipment related informations. That is the investment property, intangible assets. That means the assets which we cannot touch and feel. For example, we can say the goodwill of the organizations. Okay, so branding of the organizations, that is the intangible assets. Okay, what is mean by the tangible assets? So those assets we can touch, feel. Okay, that means the machineries, computer systems. Okay, so all these are the tangible assets, and the goodwill. Okay, so the brand value of the organization. So all these are the intangible assets. So that intangible asset should also be there in your balance sheet. Next one is the some of the financial assets like we can say the cash equivalents, we can say the treasury bills, commercial papers. All these are the financial assets. We can say the investments accounted for using the equity methods, the biological assets with the scope of AS1. That is the some of the agriculture. If the company is the agricultural, we can say they produce the agri allied products or the close. That is the inventories. Okay, what is the position of the inventory? That is the position of raw material, position of the work in progress, position of the finished good inventories. So what is the position of all this? That should be there in your uh, is in your balance sheet. Next one is the trade and the other receivables. That is the current assets. Okay, so what things you are going to receive within the 365 days. Next one is the cash and cash equivalents. That is the total of assets classified as a held for sales. Assets included in the disposal groups classified as a held for the sales in accordance with the AS5. That is the some of the assets that we classified as for the sales. Okay, it may be the any property that company is declare is for sales. That should be declared in your balance sheet. That is the trade and other payables. That is the non-current liabilities. That means whatever we can say some raw materials, some other accessories, and all these things. If you order, or we can say we get it on a credit basis, then the organization has to pay for this. That is the trade and the other payables. Some of the provisions for we can say the some of the financial obligations, financial liabilities. Okay, so all these some of the tax, all these things, that is the liabilities included in the disposal group classified as held under for the sales in accordance with the AS5 105. Okay, so that included that must be included the non-controlling interest presented within the equity. So all these things should be there in the balance sheets. Okay, so if we read that 55 number point, that entity that shall present the additional line items, including the disaggregating the line items listed in the paragraph 54. Okay, so some of the entities that are the additional that heading the subtotal in the balance sheet when such a presentation is relevant to understand the understanding of the entity's financial position. Okay, the some of the other entities that should be include that that which we can say the some of the parts of the entities which include in the 54 numbers points. Okay, so these are some guidelines for the balance sheet. Okay, when we read the 56 point, when an entity present the current and non-current assets, okay, that means your assets should be classified into the two types, that is the current assets and non-current assets, and the current and non-current liabilities as a separate classification in its balance sheet that should not classify. Okay, so all these classification should be there in the balance sheet, that is the current and non-current distinction in assets as well as in the liabilities should be there in the balance sheets. Okay, so these are the guidelines for the balance sheets. Okay, so we don't have that enough time to read all these things. Okay, so I will share this PDF to you guys. If I can able to share in a chat box, then I can share with you. Let's try that. Yes, I can share this PDF with you. It's just a second. Just confirm when you receive that PDF in a chat box. Can anyone confirm? Please see your chat box. I share a PDF of Indian AS1 with you guys. Please confirm that you received that in a your chat box. Can anyone confirm?
Yes, sir.
Okay, thank you. Okay, so guys, please download this PDF that is for Indian AS1, and whenever you have a time, please read it. Okay, so then you slowly understand the balance sheet. Okay, so what are the different guidelines? Okay, what are the guidelines for the assets, the guidelines for their classifications, guidelines for the inclusion and the exclusion of the different parameters of the assets and liabilities. Okay, what are the different types? Okay, how we classify the equities. So all these guidelines is present in this we can say AS1. So these are the generalized guidelines that we receive in this AS1. Okay, we will read the guidelines for the profit and loss. If you see here on the screen, that is the statement of the profit and loss. Okay, so what are the different guidelines for these financial statements that we are going to understand? That is the statement of profit and loss shall present in addition to profit or loss and other comprehensive income statement. Okay, so what we can say, uh, what are the different sections? That is, we can say profit or loss, total other comprehensive income for the period being the total of the profit or loss and other comprehensive income. That means the 81A told us that the profit and loss account or the statement shall must represent the position of the company or the organizations. Okay, that is their financial performance position. That is, they are generating the profit or they are generating the loss, and or their total other comprehensive income. We know that the company or the organizations are generating their incomes with the different sources. Okay, so there is one source, that is the operating income. We can say by doing their main business by selling the goods and services. If we can say, uh, if any organizations, if we take the example that if I say the iPhone, so iPhones main business is to sell to, we can say, make the mobile phones, smartphones, and sell that smartphone into the market. Okay, so it is the main business. If so, whatever they are generating a revenue by selling the mobile phone is their main, we can say, the operating income. So they can also generate the income through different sources. If they invest the fund anywhere, so they receive the interest. Okay, if the Apple have the property, if they rent that property, they receive the rent. So these are some other incomes. Okay, so what is the total income of the organization then? That is the summation of all these incomes, summation of all these revenue. Okay, so is 81A guide us on, we can say, how we may enter the revenue. So 18B tells us that an entity shall present the following items in addition to the profit or loss and the other comprehensive income sections as the allocation of the profit and loss or the other comprehensive income for a period. Okay, we can say, so all these are should be that is the profit or loss for the period attributes to non-controlling interest and the owners of the parent, owners of the parents. Okay, the comprehensive income for the period attributes to. So all these guidelines on these guidelines for the revenue inclusion in the financial statements. Okay, so these are some guidelines on how the, in addition to the items required by the other Indian As, that is the profit and loss sections of the statement of profit and loss, shall include the lines of items that present the following amounts. That is the revenue. First one is revenue, that presenting separately interest revenue. Okay, so we classify the revenue into the different types. That is the revenue from the main business, then the revenue from the other sources also. Okay, so that we can say all these things should be there in the income statement. That is the revenue, then the different types of expenses or the different types of cost. Okay, also here given the guidelines for the tax as well. If you read. Somewhere it's given. I see the guidelines. Just a second. Here, the tax expense. Okay, so after we can say if we deduct the tax expenses from the operating income, we will get the net profit. Okay, so that entry should be there. What is the tax paying by the organizations? Okay, so all these are the guidelines for the can say profit and loss account. Let's see. See, guys, this is the uh, format for the profit and loss account is given here. If you see the clear format, that is the first point is the revenue. That is the revenue from the, we can say, the main business. That is the operating business. Next one is the other incomes. Okay, so companies also have some other income as well. Okay, the third entry, changes in the inventories of the finished goods and work. Okay, we know we always enter the opening balance and closing balance of the different inventories. That is the raw material, work in progress, and the finished good inventories. Okay. Next one here is the things are already given. That is in progress, raw material, consumable. Okay. Employee benefit expense, that means the salaries of the employees. These are the expenses for the company or the organizations. So that entry is here. That is the depreciations and the amortization expense. That is the depreciation. We know that while the production we use the machineries, but the machineries depreciates over a period of time. That means the value of that machinery gets decreases if the machinery gets older. So what is the depreciations? And we also add the other expense. If we, for example, if we say the electricity expense, rent. Okay, so all these are the other expenses. Now we can see the administrative expenses, advertising expenses, all these be included in the other expense. Then we get the total expense. Okay, when we minus the revenue from the all the expenses, we get the profit. That is the gross profit before tax. Okay, then we minus the other operating expenses. Then we get the operating income, and then we minus the tax. Okay, so this profit is the before tax profit. Up to that point, we not paid any tax. Okay, so this is the format for the profit and loss account. Okay, so these are the guidelines given in the AS1. So here we can see, if you see the next statement, that is the statement of changes in equity. So that information to be presented in the statement of changes in equity. So what are the different guidelines? If we read the point number 106, that entity shall present a statement of changes in equity as required by the paragraph 10, and the statement of change in equity includes the following information. Okay, so that statement of changes in equity must have the following information. So what is that information? Total comprehensive income for the period. Okay, so that should be there in the statement of the change in equity, and showing the separately the total amount attributable to the owners of the parents and to the non-controlling interest. Okay, for each components of the equity, the effects of the prospective application or the retrospective restatement recognized in accordance with the with Indian AS 8. So in the accounting standard 8, we study the standard in the upcoming sessions. Okay, so that means whatever the situations of the equity, the equity of the shareholder is increases in the organization or company, or decreases, that we are going to understand. Okay, so that entry, that is, we can say the income or the reserve, or we can say if the further investment of the owner. So all these entries should be there in the financial statement. Okay, so at D point, if you read, for each components of the equity, the reconciliations between the carrying amount at the beginning and the end of the period are separately a separate entry should be there. That is the profit or loss, other comprehensive income, and the transactions with the owners in the capacity as the owners. Okay, whenever after we can say uh, in between the, we can say, financial year, whenever the owners of the organization has a fund, okay, so he can invest in the business. So whenever he add the extra investment, extra money, extra fund, automatically equity of the owners in the business gets increases. Okay, so we add all the transactions. Okay, or changes in the ownership. Okay, so whenever he adds the funds, his ownership in the business gets decreases. If he taken out the fund, automatically his ownership. So in the, we can say, in the change in equity statement, actually we analyze